In this video, we're going to take a look at 3 more popular high-yielding investments that are at a greater risk of seeing a dividend reduction. The main reason I believe these investments could potentially see a dividend cut is because they've been reporting pretty bad financials that suggest they won't be able to fully cover their dividend at their current rate. I won't say these investments are guaranteed to go through a dividend cut, as they could still post some pretty good results in the next quarter, but as I'll go into more detail for each company, there's at least a strong likelihood of a cut coming. So with that being said, let's get right into it. The first stock in danger we're going to take a look at is Trinity Capital, ticker TRIN. According to their website, their goal is to fuel disruptive technologies that are revolutionizing the future. In other words, they're a business development company that specializes in venture debt, which means they lend money to startups still in their early growth stage. This is unlike most BDCs that provide funding to more established companies like Uber and Instacart. Trinity lends money to companies that most BDCs probably wouldn't even consider, including cryptocurrency startups and space exploration companies. This puts them in the same league as Hercules Capital and TriplePoint Venture Growth, who also lend to these early-stage businesses. Trinity Capital has been around for several years, but they only recently became a publicly listed company a few years ago. They were really the darling of the BDC sector all throughout 2021 and early 2022. They were known for very aggressively growing their dividends and paying a lot of special dividends. Up until last quarter, this BDC increased their regular dividend every quarter for 3 straight years and paid a total of 6 special dividends. It was the fastest rate in terms of dividend growth in the whole sector, and a lot of high-yielding investors flocked to this company. When interest rates started to rise, it did result in some good results initially, just like it did for most BDCs. Thanks to their floating rate loans, they initially saw an increase in net interest income. But as rates have remained high, borrowers have started struggling to pay back Trinity Capital. This company has gone from earning 57 cents per share in Q4 of last year to 54 cents in Q1 to now 53 cents per share. This gives their stock a current payout ratio of 96.2%. This is a pretty big fall from 9 months ago when it was a comfortable 87%. As you can imagine, when the economy gets rough, it's going to add extra pressure to these BDCs that invest specifically in startup companies. We've already seen TriplePoint Venture Growth reduce their dividend, and now Trinity is coming dangerously close to that as well. Fortunately, the other company in this subsector, Hercules Capital, has kept doing pretty well, as they have a payout ratio of just 78%. They've been the best among this group of BDCs, and likely they're the only one I'd consider investing in that targets these startups. But going back to Trinity, if they continue down this path they've been going down, a cut is likely to happen. It's just been getting worse for them for almost a year, but hopefully rate cuts will provide them with some relief, but the question is whether or not it'll be enough relief and if it'll be soon enough. The next stock in danger is BlackRock TCP Capital Corporation, ticker TCPC. They describe themselves as an externally managed specialty finance company that's focused on middle market lending. BlackRock TCP Capital Corporation's investment objective is to achieve high total returns through current income and capital appreciation with an emphasis on principal protection. It says, "We invest primarily in debt of private, middle-market companies with enterprise values typically between $100 million and $1.5 billion, including complex situations that require specialized industry knowledge." Just by looking at the surface-level information, TCPC appears to be a pretty attractive investment. With a dividend yield of over 17%, and the fact that it's been paying the exact dividend amount it did when they first had their IPO, it would likely be a pretty enticing investment for income investors. However, on their latest earnings call, TPC made a pretty surprising announcement regarding the health of their investment portfolio. CEO Raj Vig announced that 6 companies were added to their list of non-accruals in the previous quarter. This grew their total percentage of non-accruals from 1.7% to 4.9%, meaning they went from being better than average to now worse than average in the sector. Their NAV per share also decreased by 8.4%, which is a pretty big drop for a single quarter. The news caused their stock share price to fall by almost 18% over the course of 2 weeks, and they've still been down roughly 26% for the year. This really highlights the dangers of investing in these kind of companies. It is rare, but you can really see how impactful just one bad quarter can be for these investments. Now, TCP has had difficult quarters in the past, and they're nowhere close to having the same strength as the bigger names like Ares Capital or Main Street. Their net investment income was pretty steady, but you can see that their last quarter they reported a big drop. Their payout ratio is a little more comfortable than Trinity at 89.4%, but the dramatic drop and the downward trajectory make TCP a company that I personally wouldn't want to take a chance on. Just like another high-yielding stock that's seeing difficulties, which is PennyMac Mortgage Trust, ticker PMT. This company issues and holds mortgage-related assets, including home mortgages and mortgage servicing rights. This company is one of the largest lenders of mortgages in America. Back in 2019, they were the third largest mortgage issuer in the country, and they report over $1 billion of net income every year. With a company of this magnitude, you would think they do a pretty good job in managing their own mortgage REIT, which they launched back in 2009. And for the first few years after they had their IPO, they were a pretty good company in this sector. There was a good amount of dividend growth, and their share price performance wasn't too bad. It did have its highs and lows, but it remained near its IPO price with a consistent high dividend yield. All the while, they hold the standard mREIT investments, which include agency MBSs, MSRs, and other mortgage-related securities. Agency MBSs are pools of residential mortgages that are guaranteed by government-sponsored enterprises. The two GSEs that exist are Fannie Mae and Freddie Mac, and these agencies back all the mortgages in these MBSs. If any of these home mortgages fail, then the agency will buy back the mortgage at its original value. Since they're guaranteed investments, they don't offer high yields, so what mREITs will do is they'll use a lot of leverage to boost their returns, and that's how these stocks offer these very high dividend yields. PMT also holds a lot of MSRs, or mortgage servicing rights. These are agreements set up by a mortgage lender to have a third-party company manage the mortgage on their behalf. The third-party company is responsible for collecting the payments from the borrower and performing other administrative services. So to give an example, a lender will issue out a mortgage to an individual, and then they'll give PNT the responsibility of collecting the payments and forwarding them on to the lender. In exchange for this, the bank will pay PNT a certain amount for servicing the mortgage. That's how these things work, and it is odd that being a mortgage lender themselves, they apparently service mortgages that are issued by other lenders. Thanks for this company took a massive downturn during the pandemic when they saw huge losses that resulted in a collapsing share price and a dividend reduction. Fortunately, they did recover, but their share price and their dividend were permanently affected. That isn't unique to this mREIT, as this was pretty standard for most mREITs in the sector, but in the past few quarters specifically, things have kept getting tighter for this company. In their latest quarter, they reported a big drop in their earnings, with NII sliding to $71.2 million. They reported $74.2 million in Q1 and $90.5 million in Q2 of 2023. To their credit, this downward trend is pretty similar across the board for all mREITs right now. And specifically for this company, they have done a better job at retaining their NAV compared to the sector. But some people, I think, make the mistake that PennyMac is similar to Freddie Mac or Fannie Mae, which are government-sponsored enterprises. PennyMac has always been a public company, and there isn't that safety that exists like there is with GSEs. So with that being said, rate cuts will provide the relief that all these companies need. BDCs will have fewer non-accruals, and mREITs will be more profitable from their investments. But the important question is whether these cuts will be significant enough before they suffer even more, which is hard to say at this point. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.